What's up everyone, welcome back to another video with the Millennial Finance. For many of us, this is probably the first real bear market that we've experienced in our investing careers. In fact, 2022 is on track to be the worst year in terms of stock performance ever since the last major recession in 2008 and before that in 2002 when the dot-com bubble burst happened. So, this is not your average bear market where we see a small drop. We're actually looking at major declines across the board and we have no idea when all of this will stop. With an influx of us really starting to invest our money in the stock market after the crash in March 2020, it's been pretty plain sailing since then because the stock market has been on a major bull run in both 2020 and to an extent 2021. Well, this year doesn't look so good. So yeah, many of us are in our first ever bear markets. Today, we'll be talking about how to survive this bear market so that we can make it out to the next bull one. Let's get started. Cha-ching! Before we start, if you want to start investing in stocks or ETFs in the US or in Malaysia, then check out Rakuten or Interactive Brokers. We'll leave our link down in the description below and you can also watch our reviews on both of these platforms. Anyway, on to the first point of how to survive this bear market, and funnily enough, the main thing that we need to do in times like this is just to survive. This is especially true for people who are trying to trade around their positions. At this point, we're not looking to maximize gains or eke out those small profits. Since the markets move in bull and bear cycles, all we got to do is make it to the next stage without losing it all. Many people get burnt trying to time their long-term investments through buying and selling, but it can be so easy to lose more and more money if you do it wrong. Just remember that not every single green day means that we're going to go to a bull market now and the bear market is over. Also, we need to take note that bear markets tend to have the biggest green days as well. If you had a look at March 2020, when we dropped around 34% from our highs, there were many days that we were up, 8-9%, but then the next day we'll just lose it all over again. The worst thing that you can do here is to feed into your FOMO by buying the tops and selling the bottoms of your long-term investments, where in most cases you'd just be better off holding on. Of course, if you're a trader and you have some positions open, then you don't want to turn a trade into a long-term investment. So if you've hit your stop loss, then just close the position and call it a day. The next piece of advice to survive this bear market is that we don't want to catch a falling knife. One of the most common things that we hear from new investors is the phrase, well, it's dropped so much from its all-time high, surely it can't drop anymore, right? Just because a stock or crypto has dropped 50% doesn't mean it cannot drop another 50%. The way percentages work is that, from 200 to 100 is 50%, but from 100 to 50 is another 50%. If you know that the company that you're trying to invest in will struggle in this environment, then don't rush to buy these dips. During times like this, being liquid is extremely important and no one can ever time the bottoms. If anyone is trying to sell you a course or is trying to say that this is the absolute bottom by now, then they are definitely lying. Instead, wait for strength to return to markets and try to see whether we have better macroeconomic conditions before investing a large chunk of your liquidity. Even though yes, we may not time the absolute bottom, well, buying in 10% above the bottom doesn't really make a difference over the long term. If you can't be bothered to time the market or monitor it, then we completely understand because many people are exactly like you. Well then, your option is going into our third way to survive this bear market, which is to just continue your DCA strategy. If your investment strategy means that you don't want to monitor markets and all you want to do is to dollar cost average into index funds over the long term, then continue to do so because now is not the right time to stop. We get it, things are getting spooky and you don't want to continue investing into something that is going down every single day. But hear me out. The entire objective of the dollar cost averaging strategy is right in its name. You want to have a good average cost over the long run by continuously buying in specific intervals whether the stock market is up or down. If let's say you've been doing this for the last 2 years and then now all of a sudden you decide you don't want to do your DCA anymore because you're scared, then you would have been buying the very highs of the S&P 500s, and now when it's low, you wouldn't have bought it, meaning your average is still at a high price. However, at this point, I would have to say that I would only recommend dollar cost averaging into ETFs rather than individual stocks. If you really wanted to do it for stocks, then I would recommend going for blue chips who are established and are sort of a safer play. The reason I say this goes into point number 4, which is that you should only invest in quality. As tempting as it may be, we should not be buying into garbage stocks just because they're down by so much. I've seen so many of my close friends who are buying into stocks and their entire thesis is that, it dropped 90% from their all-time highs. Their thinking is that since it dropped by so much, I have the most potential gain as soon as this rockets back to its old price, right? Well, sometimes they do, but most of the times, these stocks are down 90% for a reason. Since this isn't your average bear market and it will most likely become a recession-induced one, then some of these companies may even struggle to survive through it. During the recessions of 1980, 1990, and the 2000s, 17% of publicly listed companies went bankrupt, went private, or got acquired. In case you don't know, this is not good news if you are an investor in any of those stocks. If you look at the other side of the coin though, 9% of these companies flourished in this environment, not just in their fundamentals, but also in their stock price. So if you're choosing between two different stocks, don't let how much it dropped from its all-time highs be a factor in your decision. In most cases, if you're comparing between two stocks who are doing the same thing in the same industry, the one who dropped less is actually a better investment than the one who dropped more. This may seem counterintuitive to most people because, like I said, most people think that all stocks will go back to all-time highs, but like I said, this isn't necessarily the case. The reason that a stock that drops less is actually a better investment is that investors are not stupid. They know certain companies are stronger than others, and that is the reason that the stock actually dropped less. When we resume to a bull market, these stocks will actually skyrocket and they can potentially go way past their all-time highs. An example of a company that never recovered from their all-time high yet is Cisco. Since the dot-com bubble burst in 2000, Cisco has not recovered their all-time high and it has been 22 long years. And this is a solid, established company like Cisco who generates so much revenue and so much profit. So imagine what will happen to your garbage stocks. Anyway, the fifth thing that you can do to survive this bear market is that to make sure you have your rainy day funds all set up. We've been talking about this over the last 2 years on this YouTube channel, but the economy has done really well and we've been in a major bull market, so maybe some of you think that it's not so important, but times like these show exactly why we need it. So there's 2 reasons why I think it's especially important for us now to have this bank of cash. The first reason is that I believe we will go into a recession and unfortunately this could lead to some job cuts. If you were in the unfortunate position and this happens to you, then you would want to have at least some of this cash, 6 months or 12 months worth of expenses in your bank account just so you can sustain yourself until you find your next job. The second reason having a nice amount of cash in a rainy day fund is important is because if we treat our investment assets as money that we don't need for the next few years, then we are far less likely to sell when we are in massive fear. For example, all my investments in the stock market is money that I assume I won't need for the next 5 years, meaning I won't panic even if we drop another 20-30%. Even more so, my investments in crypto is assumed totally lost for me, and if I lost every single dollar of that, it wouldn't really hurt me. This means that when Solana dropped from $100 to $40 where it is now, I'm still able to hold it strong and I'm not forced to sell everything just because it dipped by so much. So imagine if you didn't have your rainy day funds and you're forced to sell your stock and crypto investments right now, you'd be selling at a very low price, and when we go into the next bull cycle, you have to rebuild everything again. This could mean buying at higher prices, which is of course not so good for the long term. The sixth thing that I think everyone must do to survive this bear market is to stay liquid. If you haven't been paying attention to any of the previous 5 points I mentioned, then make sure you listen to this one. Now, when I say stay liquid, I don't mean sell off all your investments, all your stocks, and all your crypto because it's probably too late to do that now. What I'm trying to say is that you should not commit yourselves to long-term assets that are not so liquid. This includes stuff like OTC stocks, NFTs, investments into private businesses, or everyone's favorite, investing into real estate. The reason for this is that bear markets often cause massive panic, and when there's massive panic and an illiquid investment, then people will start undercutting each other just to get rid of it. Since they're illiquid, let's say things are really starting to look extremely bad and you need the cash, it will be very hard for you to sell off these assets because you would need to find a buyer. For example, if I have an investment in the S&P 500 through the ETF SPY, if the stock market drops by 10% and there's news that the US is going to crash for the next 5 years, I can dump these SPY shares no matter how much I have onto the market because there's always buyers and there's a very thick order book. However, if instead of buying SPY stocks, I instead bought a house, if the housing market were to crash for the next 5 to 10 years, I would find it very difficult for someone to buy it from me because it just doesn't work the same and it's an extremely illiquid investment. Personally, yes, I have been talking up a lot about NFTs, but I am significantly de-risking from it because just like real estate, they are also a very illiquid investment. Anyway, the final point to survive this bear market is a fairly simple one, and it's that you should just chill out and stop checking the prices of investments every so often. If you're the kind of person who checks their portfolio 10 times every single day, don't worry, you're not the only one, but what I'm telling you is that just checking these prices won't change anything. All it will do is freak you out even more. Of course, if you're a short-term trader, then you should definitely be doing this so that you can cut your losses or take your profits as soon as you can. But if these are long-term investments, then there's no need to worry. This is a time for us to finally touch some grass, breathe some fresh air, and reconnect with friends and family. Just remember that whatever happens to the stock market, even if it's down extremely bad, it's not the end of the world. Things will still go on, and this is especially true if you're a young investor like myself. Even if things dip 80-90%, it shouldn't really matter much for us because, we still have 30-40 years more for us to rebuild our portfolios, work, gather some cash, and retire as millionaires. So, while there's no guarantee about how low we can go or how long this will last, sticking to your investment strategy and being patient is key. Bear markets make millionaires, and this is the perfect opportunity for us to deploy our cash. I remember the bull run that we've had over the last 2 years, and I was in such a dilemma because I wanted to invest more money into the stock market, but I didn't want to keep buying stocks at their all-time highs. At the time, I wished things could retrace a bit so that I can invest more money. Well, not gonna lie, now that it has retraced, I'm starting to panic a bit, but I'm following my investment strategies and I am buying more and more stocks. If you're watching this and you're feeling down because your portfolio doesn't look so good, then don't worry, all I have to say is that we're all gonna make it. If you want to sign up for a broker, check out Rakuten or Interactive Brokers. Both their links are in our description below, and let us know down in the comments below. Are you investing more money in this bear market? Thanks for watching this video to the end, guys. Give us a huge thumbs up and subscribe to our channel if you haven't already. See you guys in the next one. Peace out.